All right, let's dive right in. For the next few minutes, just think of me as your guide. We're going to learn how to really read a company's story, not from the headlines, but from the numbers themselves. You ready? Let's get started.
So, you see a giant company like Infosys everywhere, right? In the news, on the stock market, but how do you actually know if they're doing well? How do you look under the hood and see if the engine is really running smoothly? Well, that's exactly the question we're going to answer today.
The key to it all is a document called the income statement. You might hear it called the profit and loss or P&L statement. It sounds a bit intimidating, I know, but it's really not. The best way to think about it, it's just the company's report card for a specific period, like a quarter or a whole year.
And just like your report card from school, it tells a story of performance. It shows you the wins, the losses, and exactly how well the company played its cards over that time. Honestly, it's the very first place any serious analyst is going to look. Now, this whole document, which can look pretty long and complex, actually boils down to this one simple, powerful idea. How much money came in the door, how much did it cost to run the business, and what was actually left over in the end. That's it. That's the core story right there.
To make this even clearer, I want you to picture it like a staircase. We're going to start at the very top with all the money the company made. And with each step we take down, we subtract a different kind of cost until we get all the way to the bottom, to the final profit.
Okay, let's walk down it together. Imagine a company makes, say, 10 crore rupees in sales. That's our top step. Step 1, revenue. Now we take away the direct costs of what they sold, let's say 6 crore. That gets us to step 2, gross profit of 4 crore. Next, we subtract the day-to-day running costs, things like salaries and rent, maybe another 2 crore. Now we're at step 3, operating income. And finally, after we pay the bank its interest and the government its taxes, we land on the famous bottom line, step 4, net income. See? Each step tells you a little more about how efficient the company is.
Okay, so theory is one thing, but let's make this real. We're going to leave that simple example behind and do what real analysts do. We're going to take this exact framework and apply it to one of India's biggest tech companies, Infosys, and see what its story really is.
And we're not using made-up numbers here. We're looking at the actual figures from the official Infosys annual report. This isn't a textbook problem. This is the real deal. These are the numbers the company shows to the entire world.
First up, the top line. A massive 1,60,000 crore rupees. That's the total amount of money Infosys earned from all of its software and consulting projects all over the globe. This number is the very beginning of their financial story for the year.
Now, after they pay for their major costs of doing business, and for a company like Infosys that's mostly employee salaries, they're left with 50,000 crore rupees. That's their operating profit. This number is huge because it tells us their core business model is very, very healthy. It shows they can sell their services for a lot more than it costs to provide them. That's the sign of a strong operation.
And here it is, the bottom line. After every single thing is paid for, interest on loans, corporate taxes, you name it, Infosys is left with a net profit of 26,000 crore rupees. This is the cash they can use to grow the business, pay out dividends to their shareholders, or just save for a rainy day.
So what does an analyst see here? We're not just seeing random numbers, we're seeing signals. Strong revenue growth, that points to expansion. Stable margins, that shows they have good cost control and pricing power. And a rising net profit, well, that's fantastic for investors because it can boost something called earnings per share, or EPS. And EPS is just the net profit broken down for each single share of stock. A higher EPS often means a higher stock price.
But here's the secret. This is where we go from just reading to actually analyzing. The numbers are just the start. The real skill, the real magic, is learning to ask the right questions about those numbers. And this is the most important part of our whole conversation.
If you remember one thing from today, let it be this. A rising profit number looks good, sure, but it's totally meaningless until you understand the story behind it. The why is always, always more important than the what.
This right here shows you the difference perfectly. A surface level look says, oh, net profit is up, great. But an analyst immediately asks, wait a minute, did that profit go up because their main software business is crushing it? Or did they just sell an office building? See the difference? One of those is a sustainable, growing business. The other is a one-time sugar hit that might be hiding bigger problems. You always have to look for the quality of the earnings, not just the quantity.
Part of digging into that why is understanding a basic accounting rule called accrual accounting. It sounds technical, but it's simple.
It just means Infosys records revenue when they finish the work and send the bill, when they've earned it, not necessarily when the client's money actually shows up in their bank account. And why does this matter? Because it gives you a much truer picture of how the company actually performed during that specific year or quarter.
Okay, we've covered a lot, but I want to leave you with one last powerful idea. This is the golden rule that really connects everything we've discussed to the bigger financial picture.
You should memorize this. Seriously. Revenue looks good, it's impressive, that's vanity. Profit shows you have a real, sustainable business model. That's sanity. But at the end of the day, a company can't run on promises. It needs actual cash in the bank. That is reality. This little phrase is the perfect bridge from the profit story to the cash story.
All right, today we're putting on our detective hats. We're going to look past a company's big, flashy headline profit number and figure out what's really going on with its financial health. Let's get into it.
So, you've seen the headlines, right? A company just smashes its earnings expectations, posts record-breaking profits, the stock probably pops, and everything looks amazing on the surface. But is that bottom line, that final net income number, telling you the whole story? Well, the short answer is not even close. Sometimes that really impressive number can be a bit of an illusion.
So, our investigation starts with a really simple but incredibly powerful question. Where did this profit actually come from? This is the first and, honestly, the most fundamental clue to figuring out what analysts call earnings quality. Now, what's so important here is this idea of repeatability. Just think about it for a second. A genuinely healthy, strong company makes its money from what it does day in and day out. Selling its actual products or its services. That's sustainable. That's high quality. But profit that just pops up from some weird one-off event, that's a whole different story. And here is our number one tool for this part of the job, operating income. You might also see it called EBIT. What this number does is it strips away all the extra financial noise, things like interest payments and taxes, and it just tells you one thing. How profitable is the company's main business? Is the factory actually making money? Are the retail stores profitable? This is the number that gives you the real answer. So, what kind of noise are we trying to filter out here? Well, these are the classic distractions. Imagine a company that sells coffee suddenly reports a massive spike in profit. You dig in a little deeper and you realize, wait a minute, they didn't sell any more coffee. They sold their old headquarters building in a hot real estate market. I mean, that's great for them, but it's a one-time thing. They can't sell that building again next year. That profit didn't come from their core, repeatable business. And this really gets to the heart of our first step. As an analyst, or even just as a curious investor, your job is to be the filter. You have to separate the consistent, reliable profits from those flashy one-time gains that, let's be honest, probably won't be there next quarter. Okay, so we've isolated the profit from the core business. We're feeling pretty smart about it. But what if there's another layer to this mystery? What if even that clean operational number isn't giving us the full picture? And this leads us to our second, and you could argue, most important clue of all. It's time for clue number 2. And it's simple. We follow the money. I mean that literally. Our second step is to verify that the profit a company is claiming on paper has actually turned into cold, hard cash sitting in its bank account. This is a super famous saying in finance, and it's famous for a very good reason. Revenue? Yeah, it looks impressive. That's the vanity part. Profit shows you're on the right track. That's sanity. But cash? Cash is what pays the bills, what funds new ideas, and what keeps the lights on. Cash is reality. So why on earth can profit and cash be two totally different things? Well, it all comes down to two different financial statements. The income statement, where you find that profit number, is based on something called accrual accounting. All that means is a company can record a sale and the profit from it the very second a contract is signed, even if the customer hasn't paid a dime yet. But the cash flow statement, it doesn't care about promises. It's a realist. It only tracks actual money coming in and actual money going out. And that brings us to the absolute core principle of step 2. If a company reports, say, $1 billion in profit, but its cash from operations is really low, or worse, negative, that is a huge, waving red flag. It could mean they aren't actually collecting the money their customers owe them. A healthy profit must be backed up by healthy cash flow, period. Okay, so we've gathered our clues, we've checked the source of the profit, and we've verified it with cash. Now it's time to put it all together and deliver our final verdict. What exactly are high-quality earnings? And here it is. This is the simple two-step check that you can use every single time. First, ask, Is this profit coming from the main repeatable business? To find out, you look at the operating income. Second, you ask, did that profit actually turn into real money? For that, you compare what the income statement says to what the cash flow statement says.
So when you boil it all down, this is the whole point. When you hear that phrase, high-quality earnings, this is what people are talking about. It's not just a big number on a page. It's a number that's sustainable because it comes from the core business. And it's real because it's backed up by actual cash. Now, that is the kind of profit that signals a truly healthy company.
Have you ever looked at a huge company and just wondered, how do they actually know if they made any money? Well, they have a special document for that. It's called an income statement. And I know it sounds intimidating, but I promise you by the end of this, you'll see it's really just a story. A step-by-step story that we are going to walk through together. Right? I mean, just imagine a global company. They're making millions, maybe billions of sales. How on earth do they take all of that chaos, all of that activity, and boil it down to answer the one question that matters most? Did we win or lose? Did we make a profit?
And the answer is the income statement. But listen, I want you to get the image of a boring spreadsheet out of your head. Instead, picture a staircase. That's what it is. We're going to start way up at the top with all the money the company brought in. And with every single step we take down, we're going to subtract a specific type of cost until we land at the very bottom, on the final number, the profit.
So to put a formal definition on it, the income statement, or as you'll often hear it called the P&L for profit and loss, shows you a company's performance over a period of time. Now, that word period is absolutely crucial. This isn't just a snapshot, like a single photo of the company's finances. That's a different report called the balance sheet. No, the income statement is the whole movie. It tells you the story of what happened financially from the beginning of the year to the end. And to make sure this isn't just theory, we are going to get our hands dirty. We're going to walk down the staircase of a real live company, Infosys, the global software giant. This way, you'll see exactly how every single number we talk about plays out in the real world. All right, are you ready? Let's go to the top of that staircase. We're about to take our very first step down, and this is where we find the company's most basic, most fundamental level of profitability. Everything, and I mean everything, begins with revenue. You'll often hear this called the top line, and now you know why. It's literally at the top of the statement, at the top of our staircase. For a company like Infosys, this number represents every single dollar they earned from all their software projects and consulting jobs across the globe. From there, we take our first step down by subtracting something called the cost of goods sold. And boom, what's left is our first key number, gross profit.
So what in the world is this cost of goods sold? People usually just call it COGS. Well, think of it this way. It's the cost of the stuff that goes directly into what you sell. If you're Ford, it's the steel for the car body, the rubber for the tires, the glass for the windshields. It's only the costs that are directly tied to making that one car.
Okay, you might be thinking, but what about Infosys? They don't have steel or tires, and you're exactly right. For a service company, their product is the work of their people, so their cost of goods sold is overwhelmingly the salaries of the software engineers, the project managers, and the consultants who are actively building the software and serving the clients. It's a fantastic example of how this one principle works for any kind of business.
And this is why that first number we calculate, gross profit, is so incredibly important. It tells you how efficient the company is at its absolute core. Before we even think about paying for headquarters or running a marketing campaign, this answers the question, can we deliver our service for more than it costs us to make it? An analyst looking at Infosys doesn't just see a number. They calculate the gross profit margin as a percentage to see if that efficiency is getting better or worse over time. It's the purest signal of whether the basic business model actually works.
Okay, deep breath. We've accounted for all the direct costs of making the product. Now we're heading down to the main landing on our staircase. This is where we deal with all the other costs of just, running the business.
So we take our gross profit from the last step. And now we take another big step down. This time we subtract a whole bucket of costs called operating expenses. And where we land is another super important metric, operating income.
So what goes into this bucket? Well, think of operating expenses as the cost of keeping the lights on. For Infosys, this is not the salary of the programmer on a project. Remember, that was COGS. This is the salary for the folks in HR and finance. It's the rent for their big corporate offices. It's the money they spend on advertising. It's all the stuff you absolutely need to run the company, but it isn't directly tied to building one specific piece of software. And that brings us to operating income.
Now, you will very often hear this called EBIT, which just stands for earnings before interest and taxes. This number is a huge deal for analysts because it tells you how profitable the company's core business is. It strips away all the noise from financing decisions or tax laws and just says, is this company good at what it does? It lets you compare the pure operational health of Infosys directly against its biggest competitors, totally apples to apples.
We are almost there. Seriously, we're on the final flight of stairs, making our way down to the ground floor. This is it. This is where we find out what's really, truly left over after every single bill has been paid. Okay, so from that operating income, we take two final, smaller steps down. First, we subtract any interest expense. That's the cost of any money the company has borrowed. Second, we subtract the tax expense, which is what they owe the government. And that number, waiting for us at the very bottom of our staircase, is the famous net income. Now, it's really important to get that these last two expenses are considered non-operating. Why? Because paying interest is a result of a financing choice. Did the company decide to take on a lot of debt? And paying taxes is just, well, it's a legal obligation. They're both real expenses for sure, but they don't tell you about how well the core business is running. And there we are. We've made it to the ground floor, net income. You've probably heard it called the bottom line, and now you can see why. It's physically at the bottom of the income statement. This is it. This is the ultimate profit, the money that's left over for the owners of the company to either reinvest back into the business to grow it or to pay out to themselves as a reward. So why do investors obsess over this bottom line number? Well, for a public company like Infosys, they take that net income number and they divide it by the total number of shares that investors own. And what they get is a metric called earnings per share, or EPS, and that is powerful. It tells every single shareholder exactly how much profit the company generated for their one little piece of the pie. Okay, before we wrap up, there's one last really important thing we have to cover. For this whole staircase idea to work, for it to be trustworthy, everybody, and I mean every company, has to play by the same set of rules. There are two key principles that make sure the whole system is fair. The first one is the revenue recognition principle. This just means companies have to record revenue when they earn it, not just when the cash finally shows up. So if Infosys finishes a huge project for a client in December but doesn't get the check until February, that money still counts for that first year's revenue. The second rule is the matching principle. This says you have to record your expenses in the exact same period as the revenue they helped you earn. This is huge because it stops companies from trying to look more profitable by pushing all their costs into the next year. These two rules together are what make the story true. Welcome to The Explainer. Today, we're going to let you in on a little secret, a financial trick really, that helps you see right through all the hype and figure out if a business is actually a winner. Okay, so picture this. You walk by a food truck, and the line is just massive, right? Your first thought is, wow, they must be making a killing. But what if I told you that long line could be a total illusion? The real story? Well, that's always hidden in the numbers. See, we're always told to look at the bottom line, the final profit number. But here's the thing. Focusing only on that final number, it can seriously give you the wrong idea about how healthy a company really is. And that's because that final profit number, it gets cluttered with all this, let's call it financial noise. Things like loan payments, maybe some clever tax strategies, or even a lucky one-time sale of old equipment. None of that really tells you if they're actually good at their main job, which in this case is making and selling food. Okay, so let's actually see how this works. We're going to build a super simple income statement for our food truck, piece by piece, and uncover the real story hiding inside. All right, first step is the easy one. We just count up all the money that came in from selling burgers and fries, every single dollar. This is what we call revenue, or sometimes you'll hear it called the top line. And hey, our truck is doing pretty well. It pulled in a solid $10,000 in sales. That's a great start for sure, but it's really only the beginning of the story. Okay, next up. We've got to pay for the stuff we sold, right? So we subtract the cost of all our ingredients. The meat, the buns, the potatoes for the fries. When you take those direct costs away from the revenue, you get what's called gross profit. So, after we pay for all the food supplies, we're left with $6,000. Now, this is good. It tells us the burgers themselves are profitable, but we still don't know if the entire business is. I mean, it takes more than just ingredients to run a food truck, doesn't it? You've got staff to pay, gas for the truck, permits to get. This next part, this is where we really get to the heart of the business. And these are all the day-to-day costs of just, well, running the show. We call them operating expenses.
Think salaries, fuel, marketing flyers, basically everything it takes to keep the lights on and that grill hot. And now for the big reveal. We take those running costs, subtract them from our gross profit, and we get this number. $2,500. This, my friends, is our operating income. And this single number, it tells us almost everything we need to know. So why is this $2,500 figure the big deal? Why is this the number we've been building up to? What makes it so incredibly important for understanding this business?
Operating income is just so powerful because it measures profit from one thing, and one thing only, the company's core business. For our truck, that's making and selling food, period. That's actually why you'll sometimes hear it called EBIT. That stands for earnings before interest and taxes. It literally just ignores everything else.
You can almost think of it like the manager's report card. It's the purest test of how efficient the business is. It answers one simple question. How good is this team at turning $1 of sales into actual real profit from its main operations?
But here's the really cool part. The true power of operating income isn't just what it includes, it's what it deliberately ignores. This is the secret to getting that crystal clear picture.
It filters out stuff like interest payments on loans, because that's about how you finance the business, not how you run it. It ignores taxes, since every company's tax situation can be totally different. And it cuts out any weird one-off things, like selling an old fryer for a quick profit or paying a lawsuit settlement.
And that's the whole point. All those things can distort the picture. A struggling restaurant could suddenly look super profitable for one quarter just because it sold off its delivery van. But that's not real sustainable profit, is it? Operating income cuts right through that noise and shows you the company's true, repeatable earning power.
Okay, so now that we have this clean, focused number, what do we actually do with it? This is where its real power comes into play, making smarter, better comparisons.
This is exactly why professional analysts are totally obsessed with this metric. It lets you compare two different food trucks, even if one is funded by a huge loan and the other is totally debt-free. You're not comparing their financing deals anymore, you're just comparing who's better at actually selling burgers. It is the truest apples-to-apples test of the core business there is.
And I just love this way of thinking about it. You know, net income, that bottom line number, it might tell you how the whole car is doing. But operating income, that tells you if the engine itself, the part that actually does all the work, is strong, efficient, and really built to last.
So, the next time you're trying to figure out if a business is a good one, don't just look at the finish line. Look under the hood and check the engine. Trust me, that's the difference between spotting a flash-in-the-pan success and identifying a truly healthy, sustainable business that's built for the long haul.